Farfetch, an e-commerce company that has helped luxury brands sell online, has been hit by a slowdown in the industry, which has complicated its efforts to make a profit on technology investments and prompted credit rating downgrades in recent weeks. Farfetch operates an online luxury marketplace selling high-end fashion and jewelry that dozens of small brands and boutiques rely on as their main selling platform. It also provides back-end technology for e-commerce for department stores and brands like Harrods and Ferragamo. Despite initial hype, turns out Farfetch was not doing well in market space. The only profitable year they had was in 2021, which raised a lot of eyebrows in investment space.
Farfetch is a company that's losing a ton of money, which you know we don't like. And it's got no clear path to profitability, which you know we disdain. At least so far as I can tell. While they've got impressive revenue growth, that hasn't flowed to the bottom line. They don't even have positive earnings for interest, taxes, depreciation, and amortization. Even focusing on EBITDA, which is a more generous measure of profitability, they have only had one profitable year, which was 2021.
Coupang, Inc. announced that it has completed the acquisition of the assets of global online luxury company Farfetch Holdings plc. By providing access to $500 million in capital, this acquisition allows Farfetch to continue delivering exceptional services for its brand and boutique partners. The stunning crumbling of the company that aimed to dominate how luxury is sold online ended abruptly. How once a promising business brand started to fall apart. Burning cash. Going off path. Farfetch significantly ramped up its spending, making profitability ever more elusive in the wake of its IPO. According to Bloomberg, Farfetch burned through at least $1 billion in cash since listing. This raised red flags among investors, which is said to have been so concerned the amount of money Farfetch was spending on marketing that it dumped its £234 million stake in the company in July 2019. Increasing debt. Not just an issue of rising costs, investors have been put off by Farfetch's increasingly complicated trajectory away from its core business of providing a marketplace platform for brands to sell their wares, potentially prompted by the fact that this proved to be a particularly difficult model to carry out even with borrowings of $1.6 billion by Bloomberg's calculations. Acquisitions. They purchased Stadium Goods, a sneaker company, New Guards Group, and apparel company, Violet Grey, a makeup company. None of the acquisitions provided the value of their initial purchase price. Their acquisitions were confusing, heavily taking on inventory and operating physical stores like Browns and Stadium Goods. Many believes it was the actions of CEO that is responsible for company's failure. He was a profligate spender, trying to emulate the large American tech companies. He provided the vision for the company, but he led the company down so many bad paths.